YouTube. This is The Working Investor. I didn't think I'll be making a video today, but I have a lot of updates and I want to share with you my strategies that I'm doing to have multiple ways to generate income from a high yield dividend ETFs. Unlike most people that just buy and hold high yield dividend ETFs and just get one way of making money with the ETFs giving out dividends, I like to find multiple strategies. I look at it like a game of chess, and I want to find different strategies and to hedge against it and multiple ways to make income. So the ways that I'm doing this, I'm setting this up is that, of course, I want to make income from getting the dividends, but also I want to get income from, as there's a term called core number compounding, which is a term by the Oracle, aka Yield Max TV, where instead of watching your portfolio up and not do anything about it, you rip profits when profits are due. So let me give you an example. I've already locked in over $300 in profit today. And we'll get to that in a second. Another thing is that I'm also planning for, of course, this is a bullish strategy, but you also want to have some bearish steps that you can do if things go against you. And one of the things that I'm looking into is that doing something called tax loss harvesting, where if there is a loss, at least I could get some kind of tax advantage from that, and without selling off my, the underlying core. We'll talk about that in a second. So let's talk about the portfolio, and then we'll talk about some of the profits and talk about the tax defensive strategy. So right now in the dividends, I allocated $35,000 so far. I may put more, and $20,000 is in the Russell 2000, which is there's an ETF called IWMY, where I've already so I initially bought 1,500 shares, but then I cut it down to just the core number of $20,000, whatever amount of shares I can get. As you can see here, my average cost is $14.14. I've already ripped off almost $300 in dividends. So you notice there's some significant NAV erosion, overwhelming NAV, net asset value erosion, that when they give out the dividends, it doesn't recover pretty well. So you better hope those dividends are enough to compensate for the NAV erosion. But another reason why I like doing the core number compounding is that if you notice the trend, it goes up and then it goes down, but then there's this little point up. Instead of watching your account go up from here, from January 17 to January 31st, why don't you rip off some profits? It may buffer out and offset some of the losses when it falls down. So that's what I've been doing. My average cost was $14.14. Right now it's $14.35. So I did sell off some of it. You could see here, this is the 35. Again, this is not just theoretical spreadsheets, hypothetical jargon. This is actually trades that is settled, that's final, that I'm sharing with you my strategy. So start off the core investment in this strategy of high yield dividend accounts, ETFs, with $35,000. And I want to see what my total, I want the money back. I want to be able to get all my funds back with dividends and ripping off the top. Hopefully not losing too much with NAV. So basically today I did two sells. I sold IWMY. I ripped off 143 and 150. This doesn't include rebalance of the portfolio, but actually ripping off profits. I ripped off almost 300 in profit in IWMY, and in AMZ, I put 2,500 into AMZ. It went up to around 2550-ish plus. So I took off $50 off the top. Yes, you can argue that when you sell off some stock, you're going to lose a little bit of dividends potential, because let's say AMZ is roughly $20, $21 a share. So let's say I sold off close to 3 shares. So let's say hypothetically you'd get $1 a share. It's probably less, but let's say for simplicity. So if I lost 3 shares, I'll lose $3. But right now I'm locking in $50. So who cares if I'm losing $3? And I have this money on the side, and I could decide if AMZ comes down to a good low value, I could just buy in and be back where I started, if not better. So far my ROI is I've already received almost 1% return in 1 day since I've started this strategy, which is not bad. Again, this is a favorable market going towards me. But when the market goes towards you, why not just take profit instead of this would be unrealized profit if I would just be watching it. A bird in the hand is worth two in the bush. And if you notice from my underlyings, you'll see that a lot of my underlyings, there's something called the Magnificent Seven, and those are the seven largest holdings in the Nasdaq and actually in the S&P and arguably in the Vanguard Total Index, and a lot of other ETFs hold them. So they actually are the core for many fund managers, and a lot of fund managers have the same consensus that these are the top companies to have to lift up the market. So if you notice, from the Magnificent Seven, I have 6 out of the 7. I really just like 5 this is my personal taste. But Tesla, I'm just using it as a experiment. That's called the Tesla sandwich, which again, the YieldMax TV guy, Oracle, aka the Oracle, came up with this strategy. So I like to give credit where credit is due. I like to learn from a lot of different people, and I come up with my own type of strategy, but my idea is to have multiple ways to make money. So now, if you look at, you see the Amazon, NVIDIA, Microsoft, Apple, Google. The only thing I'm missing here is Phoebe or Facebook, high yield ETF by YieldMax. There's a couple of reasons why I don't have it here. Number one, I'm not a big fan of Facebook, but they are pretty profitable. I can't argue with that. Number two, I want to be a little bit different than there's a fund by YieldMax called the Magnificent Seven. It's called YMAG, right? So if the market takes a dump, right, and everything just goes crashing down to, like, let's say 50% value, I have to check with an accountant if this is correct. I could potentially sell out all my companies for a paper loss, and then buy YMAG, which will be very similar to my holdings that I have now, very, very similar. So there is something called tax loss harvesting, and you can see a lot of articles here as Investopedia, but there's some rules behind it. Like, I think you can buy it back within 31 days. So you're looking for two underlyings that are correlated, similar but different. I'm not sure if this may be too similar. So if anybody, check with an accountant or somebody from the IRS to see if this is appropriate, acceptable exchange, because this is a little different because it doesn't have the Facebook. Similar but different. So if you have, let's say Coca-Cola and Pepsi, and you like both, but you put $100,000 in Coca-Cola, then Coca-Cola tanks because the market goes through a crash, and now you lost $50,000 in equity. Instead of just selling it, you sell it and then buy Pepsi. So when Pepsi, if they're super correlated, let's say almost 90% correlated, when Pepsi goes up and Coca-Cola goes up, now you're back to where you were, but you have a realized paper loss of $50,000. So when you pay taxes, the $50,000, offsets capital gains or can offset your earned income. But there is a certain amount. I think it's like $2,000 a year that after you offset your capital gains, I think it's $2,000 a year that can give you and then you can roll it over to multiple years. Again, I'm not an accountant. I'm not a tax person. I'm mindful about taxes, but I want you to do your own research, your own due diligence. Speak to an accountant. Speak to someone who knows exactly what they're doing. But see if this is an interesting, viable strategy of if you're going to hold YMAG, then why not hold the underlyings of YMAG, which has a lower expense ratio? But again, like, I don't have Facebook, so it's a little different than YMAG. And then if everything takes a tumble, I could potentially sell it. A move that I could potentially do, a card I have a special card, a wild card, where I could at least soften the blow, where while I'm waiting for the market to go back up, I can have this little tax advantage right there. And I can still remain invested, but with a tax advantage. So again, I'm looking into all different, I try to be bullish and think about plans if the market goes up. I also want to think about some strategies if the market goes down, what to do. Anyways, just wanted to share my 2 cents. If you have any other interesting thoughts about this, if you disagree, if you spoke to an accountant that can give some clarity, I would love to hear it in the comments. We're all learning together, growing together. Again, I'm not a financial advisor. I'm just a person trying to make a little money on the side and sharing my journey. This is The Working Investor, over and out. Hope you guys are doing well, and keep on smiling.